Good afternoon and welcome everyone to this monthly update on commodities. It's November the 21st, and this will not be this last this year. We will have another one in mid-December. We'll release the schedule sometime soon. Before I just kick off, I have called this same as last, I think, raise growth expectation. That is really one of the key drivers we've seen in the past couple of months. But before we dwell into the details, let me just say that what I'm saying here is reflecting my thoughts on the market conditions and where we go next. Nothing I say in this context should be taken as a trading recommendation. With that out of the way, let's take a look at the current themes and current drivers for commodities. Again, from month to month, we don't see a big change. So if you have tuned in before, you have seen some of these highlighted before, and they are still with us. The synchronized global growth, OPEC, China, Trump, and geo-risks. On the oil front, we do have a relatively strong market, high compliance, rising demand, falling inventories, and now most recently geopolitical risks have all helped support the rally we've seen in oil price over the past month, with prices going to levels which I didn't really foresee that we could reach at this stage in the recovery. We're going to take a look at that later. China is likely to sacrifice some growth going into 2018 in order to get its house in order. They're going to rein in credit. They're going to take a look at the housing bubble. The anti-pollution policies could also have an impact, and these have been some of the drivers behind the metal prices, but also one of the reasons why we're now seeing some of the recent surge in metal start to fade a bit. Trump, he remains a loose cannon, both domestically and internationally. Geopolitical risk indicators, they have been increasing since Trump took office. It is driven by the risk of a diplomatic crisis, but also his tweeting habits is at best controversial. And some of them tend to, we've seen quite a few of these upset the market and created some reaction, especially on the safe haven side, which is something like gold. The delayed tax reform and absent infrastructure spending has been prompting a more dovish Fed, so the inflationary pressure has so far failed to materialize. And finally, on the geopolitical front, we do have raised tensions right now in the Middle East. We have Venezuela, where production is falling, and we got North Korea, which is once again back on the list of state-sponsored terrorists, as according to the U.S. That was announced yesterday by the government, and that potentially could trigger a reaction from North Korea. So that is something we cannot ignore. And overall, we have low volatility across most asset classes, stocks, bonds, and currencies, and that is obviously creating a bit of a nervous situation if there's any sudden change to that. We have seen this year, or at least the second half of the year, the market moving more and more towards focusing on growth instead of protection, and just the non-scientific way of looking at that is the ratio between gold and copper. We've seen that ratio hitting a 2.5-year low earlier last month. And it has showed a start. It has showed signs of recovering a bit just recently. But as you can see on this chart, the move primarily has been towards favoring industrial metals, and in this case copper over gold. Performance so far this year, some very, very strong performances and also some very weak ones. At the top, we do find palladium. We have talked about this, the move from diesel to gasoline, the move towards hybrid vehicles, which is going to support palladium demand more than something like platinum, and we also see this very strong rally in industrial metals being represented, with most of these metals being represented at the top. As you can see down here on the Bloomberg commodity sub-indices, industrial metals has really been the main provider of gains this year, to a certain extent precious metals, and then being offset by losses in energy, not least natural gas, and also soft commodities and grains. It has also been a year where we've seen that some of these gains, we've seen the dollar weaken. It's down by 8% on the dollar index, but it has not really translated into a broad-based rally in commodities, and that also obviously indicates that it's not only a question of the dollar, but taking a look at the dollar, we have now seen the IMM currency futures position return to neutral, and just 7 weeks ago we had the biggest dollar short against 8 currency futures in 5 years. But since then there's been quite quite a strong rebound in the dollar, and that has primarily actually been driven by aggressive selling of the yen. So there is quite a big yen short out there at the moment. That could potentially play into the hands of gold if that for any reason needs to be reduced, because yen and gold tends to be classmates when it comes to moves in the market. But we are seeing elevated bullish bets in commodities. Commodities has come back as a theme, especially with growth being so synchronized as it is. But you can also see here on the color scheme that the major chunk of the current position is allocated to the energy sector in beliefs that oil prices will be supported by OPEC, and Russia, but also the recent the recent geopolitical events. Moving on to another, which shows this is basically the total open interest across 22 major commodities. Open interest is really if you add up all the longs and the short positions, because it's a zero-sum game. So for every long there's a short in the market. If you add that total, that becomes the open interest. And as you can see, the open interest has been on a steady rise. These are week numbers. So since week 34, it's been on a steady rise. And what's actually right interesting right now is we are actually entering the time of year where we see seasonal decline in positioning, because traders are easing up on their positions as we move into towards year end and the holiday season. But there's no sign of that currently in the open positions, and that obviously makes the market a bit exposed when we go into December, which tends to be categorized by lower liquidity. So with that, it's also specifically a focus on the oil market, where we are oil and products, where we have some of the big extended positions. As usual, we just take a quick run through of the COP reports, the commitments of traders reports, which are released by the CFTC every Friday with data from the previous Tuesday. We put all the data into a report which we put out on trading floor every Monday. The open interest can be divided into four main major categories: producer, merchants, producers, swap dealers, and managed money, and others. Swap dealers are typically those we're seeing interesting developments there, because a swap dealer is someone who's hedging risk that they've been given by a client. So it could be a big oil company in the US asking Goldman Sachs to hedge their production X amount of barrels per day or per month. And then they issue, they give the client a swap, and the swap dealer then goes into the futures market to cover his position. So that basically means the bigger the swap short, the more hedging we're seeing. And I'll show you some charts on the oil market specifically, which is indicating quite a aggressive activity right now. But overall, the reporter tends to just focus on the managed money, because these are hedge funds. They are only here to do one thing, that's to make money. That basically means they have tight stops and they have no underlying exposure. They are reactive to changes, because they will continue to buy when it goes up, continue to sell when it goes down. But if there is a reversal, they have to adjust their positions fairly quickly, and that makes this investor group very reactive to changes in the market. It also gives us an idea about the major trends and potentially when a reversal is looming. The overview, which has just recently been updated with a few extra commodities and some more columns, but I hope you don't find it too confusing. But it basically splits the different commodities into longs, shorts, nets, and then basically a view of how the net is developing compared to recent history. And as you can see on this one, if you look at the big WTI contract, which is the top one here, traded on CME, it's currently 85% from the high seen within the last year, which is also the record. In Brent crude, it's 99% away from the record. So basically, we had a small reduction last week, which took it just a little bit away from the record high we have seen building up since October. Elsewhere, you can see gasoline and diesel. They're both into record territory. It is the high in the year, but it's also this number is the highest on record. So we have some very elevated positions there. At the end of the scale, we got a record short position, or I think it's a 4-year high in the short position in corn, making that one potentially exposed to a recovery if there's a change in the price. But also wheat has been seeing, apart from last week, has been seeing the short base expand. And in the soft commodities, cocoa is finally turned long, and this is actually the biggest long we've seen for the past year. There's a big short covering sugar last week, but looking at some of the charts, it seems some of these may have just been a little bit premature. A glance just through some of the data which is in the report every week. WTI crude, we can see this is the current nets compared to the record we had earlier this year. Brent crude, we are toying with record highs. On a seasonal basis, it becomes even more clear that we're well above 5-year averages, both in WTI and Brent at this stage. Crude oil products, again, quite aggressive buying in recent months. So we got record highs both in New York Harbor ULSD, which is diesel, and in gasoline. In the soft commodities, just taking a couple of examples there, we got coffee where the market has been on the defensive most of the year after the decline that we had during the first half. And at this stage, it seems like settling into a range here between 120 and 130, but that has not dissuaded funds from adding increased short positions. So we have a near record short position currently in coffee. In cocoa, it's interesting. Last week was the first week since this whole rally began back in I believe it was July, that we've seen the market finally switch into a net long position, and cocoa's actually been on the suffering since over the last week. So most of this rally we had in cocoa was short covering driven. Funds were not really aggressively long during this rally. They are starting to get long now, and now we're seeing some signs that the market may just has been topping out a bit at this stage. Grains, I say the outlook is so bleak that the support could be lurking, because basically we've got poor fundamentals, bearish technicals, and but also they need to get even worse to attract additional selling. So I think the market could potentially skew to a positive surprise because of the position is so elevated as it is, and also we have seen confirmation, especially from the US, that we could see the return of a La Nina weather formation, which tends to, at this stage, it's only being categorized as a weak one, but it looks like it could make a return over the coming months. And if that happens, it could mean colder winter across the northern US, which could have an impact on natural gas and some of the winter seeds. It could mean drought in Brazil, which could have an impact on grains and soft, and it could mean lots of rain in Asia and Australia, and especially Australia. The mining industry could be impacted. We've seen that in previous occurrences. So this is probably something that we need to keep an eye on, which potentially could develop over the coming months. And if that's the case, then both for the soft and the grains, there could be some support coming into the market. Where can I find all this data? Well, you can go to tradingfloor.com and look under topics, go to the cut report, or you can go into tools, and there's basically there's a function there which is provided by the CME, where you can go in and you can do your own analysis. Otherwise, there's also regular updates on Twitter. Okay, let's go to gold. If you look at these pluses and minuses, we can see this market is pretty close to neutral at this stage. And that's also really what the market is telling us. We are struggling to make it higher. We're also finding some support at the lower end of the current trading range. So there's not, the market's really in need of a spark. We haven't really seen that. Underlying, I think we're still seeing some geopolitical risk, diversification and tailing protection, providing some underlying demand. But the dollar has obviously not been much of support during the past few months. Real interest rates has been well behaved. There is a belief that inflation is going to pick up. At the same time, we're also seeing the curve been flattening. So the bond curve is not really looking for galloping growth and runaway inflation. That should keep real interest rates relatively low, and that's going to remove some of the potential hurdle that gold otherwise could face. But elsewhere, there's not really much going on. Paper demand has been relatively steady in ETFs and very volatile when we look at the futures market. But that's what can be expected with the gyrating market that we have had in gold so far this year. The drivers have not changed. If you look at the real yields, we are seeing this relatively close correlation. Also, if you look at dollar yen, we also have the close correlation between the weak yen, weak gold, and vice versa. And also we can see that there's been a bit of a divergence here. This is what the Fed funds is expected to be in December next year. And even though that's continued to rise, we've seen gold trade relatively stable. The widening gap is, I think, is due to the it's most likely due to some raised diversification demand and this geopolitical risk that the market is still perceiving as being relevant as a reason for buying gold. But overall, this is not really, there's no support coming from expectations for interest rates, but gold has nevertheless been holding up. Also, it is really all about interest rates because if you want to see what's driving dollar yen, you just have to look at the yield spread between the U.S. and Japanese government bonds, and you can see quite a close correlation between the developments there and dollar yen. So in order to gauge gold, we also need to gauge the bond yield developments in especially between Japanese and U.S. government bonds. MP is just asking about Bitcoin, and yes, I mean these days we can almost not avoid talking about Bitcoin considering the continued move. I just recently last week spent a few days in Switzerland where I did 2 seminars in Geneva and Zurich with the CME group. Where the obviously the talk of the town was CME's group announcement that they were going to launch Bitcoin, and I think we have the date now, which is going to be, I think it's believe it's December 11th, and there was a lot of questions related to the futures, and it obviously reflects the interest that that's in the market. And you ask about the cuts, if it will be as soon as the market gets to a certain level, then the cut reports will be provided by, or has to be provided to or the information has to be given to the CFTC, and once we have it, we will obviously put into the report as well, because that's going to be a very interesting one to follow. There are split assumptions about what the impact of the futures will be. There's probably a somewhat general belief that it could initially lead to a spike, but because it will open up the market to additional traders. But just considering at this stage the contract size is expected to be 10 bitcoins, which means the contract value is current money is going to be $80,000 plus dollars, and if the margin is going to be 30%, you can calculate. You can quickly see that the minimum amount you need to put up in order to trade a Bitcoin is $25,000, probably even more than that. So that's going to leave it. It's going to remove it from or primarily be a contract for institutionals, I think, at this stage. But CFDs will probably follow, and that's going to make the nominal value smaller. But potentially a rally initially, but then followed by. But then we also have to acknowledge that the playing field has become a bit more level, because now there's an opportunity to go short the market, which hasn't really existed before. And yes, the cut will be incorporated into the PDF file which I put on Trading for. Okay, that was just a sidestep, but I'm sure we would have got some Bitcoin questions anyway, so I hope that this clarified a couple of things. Returning to gold, the safe haven demand is still relevant, and we can see that I'm using this disapproval rate of Donald Trump, and as you can see, it's pretty much back to where we were back in July before he recovered when he turned tough on North Korea. At this stage, the uncertainty related to comments is going to continue to provide some support to the market. Prices has been gyrating, and so has the net positions in gold. But what we find is that during the sell-off or correction we had now for a few months, the reduction in net longs has been relatively benign, and actually we've seen a small pickup last week. It does indicate that the market is quite resilient at these levels and requires quite a bit more additional weakness in order to force out the long side, and also we have not seen any pickup in the short selling, even though the market was coming off. So there's not really any selling appetite right now. So the focus is quite a bit on how the long in the market behaving to the price gyrations. ETF positions are holding up very well. Ray Dalio at Bridgewater, as I mentioned on this previous slides, they actually came out and announced that during the third quarter they had become the seventh largest holder of the GLD ETF. So they have been buying. They have been strong buyers of gold ETFs during the third quarter, and Bridgewater is the world's biggest hedge fund. So where do we go from here? Well, according to this, we're not really going anywhere fast. The market has been sideways for the past 4 years. It's literally unchanged since Trump won the election last year. And right now, the outer bounds are really 1,200 to 1350. Still believe that, there's enough uncertainty in this world, and especially with bond yields as low as they are, and with stock markets as high as they are, and with the geopolitical concerns that which has not eased but become more relevant this year, that there'll still be the need for diversification. I think that will provide the underlying support for gold. So we maintain our year-end call of 1325. In the short term, it has been a bit challenged by this recent dollar strength and the watch on the FOMC. But as you saw on the Fed funds outlook, that's not really having much of a significant impact on the price of gold at this stage. So, but we nevertheless keep an eye on this 1260, 1250 area, and if we move above 1306, there should be some green light coming into the market once again. Silver lags because quite a bit of the gold demand has been safe haven and diversification demand. Silver tends to be lacking a bit, and that's also reflecting in the price. Silver has been underperforming gold so far this year. This despite being 50% driven by investment demand, and when we see how much investment metals has been, or in industrial metals has been going up, then the impact from rising industrial metals has not really played its part on silver this year. There is expectation that could change, and that silver may find some support as we move into 2018. At least the London Bullion Metal Association expects to see silver trading more than 25% higher this time next year. So that will remains to be seen, but I'm keeping an eye on as usual, the gold-silver ratio. 74 is a level we have struggled to break below since late summer, and that's really the trigger for some renewed silver strength relatively to gold. So that's the level I'm keeping an eye on at this stage. On the palladium and palladium have not really much changed there. Palladium remains in the driving seat just simply because it's got the same kind of pattern or structure of the curve that we've seen develop in oil recently. It's in backwardation, which means that the spot price is at the highest. That is indicating tight supplies. And we have the opposite going for platinum at this stage, and with platinum also being much more dependent on the movements in gold. Palladium has been allowed to break above the price of platinum for the first time in many years, and that premium seems to be maintained, looks set to be maintained for now. There was a small blip just this week with developments in Zimbabwe, because that country is the third biggest platinum supply in the world, but any developments there is expected to be short-lived. But overall, the tight versus loose supply is going to keep platinum relatively supported over the coming months. Copper has been copper's rally has faded a bit, but it was up on synchronized growth, weak dollar, and supply disruptions early this year. But following the Chinese Congress, there could be some challenges ahead. Xi Jinping mentioned housing was for living, not for speculation, and if there's further moves made towards bringing the housing sector under control, then that could also reduce a key source of demand for copper, i.e. into the wiring and the heat distribution. And also, we have this lower credit impulse, which does indicate that that the Chinese economy is at risk of slowing potentially more than expected next year. I think at this stage, some of the major forecasters are looking for growth to slow from 7 to 6%. But the real question is really what kind of impact they will have on demand for industrial metals. At this stage, the markets seems to be the support remains relatively strong for something like aluminium and nickel. That's where the fundamental supply-demand story remains the strongest at this stage. And you can also just see the hedge fund after hitting a record long. They have started to lose a bit of faith here recently, and we are still well above the 5-year average, as you can see. Looking at the chart, we're still doing okay. We've had only two small corrections since the rally started earlier this year. So we had 38.2% corrections. That basically means we have a strong uptrend with shallow corrections. So far, the correction of this most recent rally halted after we corrected 68.2, and that is quite a key, and so that means we basically found support just around the 303 level, and that's a level really to look out for on the downside. If that starts to give way, then the market will be focused on 290 first, and if we break that, then we'll have a lower low, and that could potentially even take it lower. But at this stage, it's still holding up. It's still holding up reasonably well. Okay, let's move to crude oil. Time is flying. I'm trying to keep this within 45 minutes. We have improved outlook or the outlook, as we can all see, has improved during this second half of 17, but there still remain some challenges ahead for 2018. So the battle between supply, demand, and inventories, I think it's too early to call it over. Actually, just Morten just asked year-end expectation for copper, basically believing that the copper. I think the copper story has run most of its course for now, because of we also into the winter months where demand generally tends to slow, and that should leave the upside limited at this stage in my belief. And also there's obviously a very, very key level above a 330, which I think is going to offer quite significant resistance. Moving back to oil, there are obviously opposing factors pulling the market in opposite directions, but as from the price action, we can see that over the last month that the bulls, they most certainly have it, and they've been given a lot of tailwind from the renewed geopolitical concerns, first in northern Iraq back in October, and now recently from the Saudi purge, which and hardened stance towards Iran, which has raised the fear in the market of a major supply disruption, and that probably has been one of the reasons why we are $5 to $10, or probably at least $5 of the $10 we see the market move. The latest move has been due to a risk premium that's come back into the market. OPEC, they will meet next Thursday in Vienna for their OPEC meeting, and it's a very important one because they need to signal that they're prepared to extend production cuts beyond March next year. I'm sure they will. The question is how if they can manage to get Russia on board already now, or whether they want to wait until March next year. Looking at the forecast for world demand next year, we just recently saw the IEA being quite pessimistic on the demand outlook, while OPEC, I just need the pointer. That was the IEA. They reduced their outlook for world demand, but also at the same time OPEC, they were quite pessimistic on non-OPEC supply, and that so that we have a bit of a divergence there. So we got the monthly report from the EIA out today, later today. So let's see where the averages will end off. But just looking at the current averages, you can see there's only a gap of 200,000 barrels. And that basically is with OPEC and Russia having cut by 1.8 million barrels, there's really only room for 200,000 roughly of those barrels to return next year. And so that clearly shows how the need, or clearly shows the need for extending the current agreement. Airline just asked, do you agree that crude oil has fully priced in a continuation of the production cuts? They have fully priced it in. As I wrote in a comment yesterday, it's like they've been boiling the chicken, for so long. Talking about extending the production cuts, that the soup cannot really get much stronger, and that basically means that I would be surprised if continued talk about extending the cuts would have any significant positive impact on the price from here. Let's take a look at some of the charts, and this is probably at this stage one of the more important ones. We before the recent real disruption and fear of disruption, we've actually had the lowest number of supply disruptions in 5 years, and that has obviously been supportive for the available supply in the market. But if we start to see that change, that could provide some underlying support. But we got multiple things to look at right now. We got the Saudi purge and increased saber rattling towards Iran. We had the Iraqi-Kurd clashes, and at this stage, oil supply from the northern fields have been reduced. But we also seen this month that Iraq has actually turned up the taps from the southern fields, and so they are to a certain extent offsetting what's been missing from the northern fields. And the big question is basically knowing Iraq's inability to comply fully, whether they will actually turn off the southern taps when the northern taps are being turned up once again. So Iraq could potentially be one of the key cheaters in the current deal. Trump's recent decision to decertify Iran is also a worry. Fall in Venezuelan output is something that continues to support OPEC's effort to cut production, because Venezuela has really been involuntarily been one of the biggest. They've had the biggest compliance because their production is basically falling. The state-owned company has been drained for funds from the government, and they haven't got enough funds to maintain production. And it's obviously a spiral that's heading rapidly downwards. Risk to Libya and Nigeria cannot be ruled out. Political instability is still what we're seeing in this country. In the US, we have the impact of lower oil prices. The rig count has been fading, showing signs of picking up once again, and we also seen production growth ending up being probably lower than where it was expected to be at the beginning of the year. We still have this discrepancy between the weekly numbers, which is provided in the weekly inventory report on Wednesdays, and the monthly numbers, which are released with 2 months delay. They tend to be more accurate, and you can see there's quite a big gap between these two, and it's going to be interesting to see which one is catching up before year end, because at this stage you can see the blue line. We've hardly had any increase in oil production this year if we look at based on the monthly data. So there seems to be a bit of a discrepancy there. But nevertheless, this is where the swap thing comes in, which I mentioned at the beginning. This is the swap dealer's net position in the WTI crude, and you can see since the market moved back to 50 and above, we've seen the swap net short more than double basically, and it does indicate that the hedging activity has been very, very aggressive these past few months, and that's obviously leaving US oil producers much more immune to price fluctuations going into 2018. It also raises the question, if we do see long liquidation from hedge funds in their near record long position, who's going to buy it? Because as the market goes up and you've got producers willing to sell, then obviously the buyer it's easy for the buyer to find offers, because that's being provided by the hedgers. When the market if the market turns, who's going to supply the contracts that or who's going to take the contracts that the hedge funds need to sell? If these hedging guys, they are basically locking in production. That basically means that the movements to the downside when it's to do with position adjustments tend to be quite aggressive because of the lack of bids compared to the lack of offers when the market is going up. So just want to be aware of. At this stage, obviously, we haven't seen any sign of any long liquidation on any scale. But it's just a word of warning if we start to see any weakness in the market. And we also, this is basically if you combine the positions between WTI and Brent, and you can see we are very, very close to the record above 900 million barrels that we witnessed back in February. And what we saw last week was the short position in WTI was reduced even further. So there's not really much of a short left in the market to absorb any potential selling from these elevated longs. So again, the risk reward on positioning alone is skewed to the downside at this stage. What has also meant is that the market has been lulled into a false sense of market being tight, because what happens, hedge funds, they buy at the front because they need liquidity, producers, they sell at the back because they're hedging production further out, and that basically means that we potentially see the market move into a deeper backwardation than is justified by the fundamentals, because funds are buying the front end, and while we're seeing selling further out. And that also means that if we do see some long liquidation, this backwardation will come down quite a bit, and that's why I'm saying it is creating a false sense of tight market. But many investors are, especially through ETFs, they are watching these curves in order to gauge whether there's a positive yield from being invested in oil, and the steeper it is, the better it is. But so it becomes quite a kind of a self-feeding cycle, and which obviously will last as long as the price continues to be supported. What else have we got? Well, the weekly data from the US, very important. As we said many times, oil market is What is lacking is up-to-date data. The only place we have data is from the US, and that means these weekly numbers sometimes end up being a gauge for will being a gauge for the global market, which is obviously not correct. But at these days where we are seeing quite a strong pickup in WTI crude exports, it is becoming much more integrated with the global market, so it does have an impact. But we can see the U.S. market total stocks are coming down towards the 5-year average, which is obviously a good thing. But most of this is driven by this very big pickup in exports. So the U.S. is basically just exporting oil to and starting to compete with Middle East producers for the Asian market, and that's obviously that's reducing the speed with which global inventories can come down. Production, as you see, this is the weekly number, which is the one that's a bit questionable because it is an estimate. It's not actual numbers. It's the EIA's estimates for production, and you can see it's trading at the highest for several decades. Well, switching now to questions, I can see MP just asked, will weekly commodity update on Friday continue? Of course it will. There's been quite a few client visits and travels in recent weeks, which has prevented me from writing it, but I do write a weekly update on Fridays, which you can find on tradingfloor.com. On the chart, very strong uptrend, especially since the middle of the year. We are finding some resistance here above 60, and I think also we have to accept that most of the rally above 60 has been driven by risk of supply, or worries about supplies being disrupted. I think at this stage we are not seeing any clear signs of that. I think Saudi Arabia is. What's happening there is he's got a lot of backing from the population, because the population has been disgruntled with the corruption that's been rife in this country for many decades. So he's got the popular support for what he's doing. The question obviously is if he can keep his friends very close to him and look after him. The confrontation against Iran, both of these countries need their oil revenue, so we see that as a limited risk of breaking into something more sinister. So there is a potential $5 premium at this stage, which is geopolitical risk driven. Nearly coming to the end, just want to touch base on natural gas. It is really in need of a cold winter and robust export to break out of its range. You can see here the red line, the front month natural gas. We had a false break here just recently, but it's really just struggling to break away from $3 therm. The La Nina I mentioned a bit earlier, if that starts to come through into January, February, March, that could potentially have an impact on, or could have quite an impact on the price, because we are entering this withdrawal season a bit earlier. And you can see we are below the 5-year average and quite a bit below where we were last year. So inventories are not as high at this time of year as we've seen in previous years. And that if we do see a cold winter returns, then there is some upside. Some like to trade this just through the spreads, because if you look at the spread between March 18 and April 18, that's really the peak winter against the first spring contract, and that's if we are seeing a colder winter, then March should rally more than April, and that means this one should go higher. And you can see at this stage it's trading relatively low, around like 14, just a 14 cents spread between the two. So that's an alternative way of looking at a potential cold impact on the price. Speculative interest is on the rise, but it's somewhat above the 5-year average. But we have seen it for this time of year. But you can also see it tends to rise as we move into the winter months. Staying with natural gas, and that's going to be my final slide this time around. We have just last week opened up for gas trading, European gas trading on the Saxo Trader platform. European gas market has really up until now primarily been reserved for the wholesale market, who have direct access to the various exchanges. We have together with a cooperation with a Dutch energy company launched CFDs on both gas and Dutch power, i.e. electricity, and if that's something that interests you, then you can take a look. These are these are some of the contracts available. There's both monthly, quarterly, and calendar years. The contracts are based on obviously trading in euros, and they are in megawatts, and it's a little bit complicated compared to some of the regular contracts. But what it basically, how you calculate the size of a contract is really the because it's traded in megawatt hours. Basically, so you basically need to find how many hours are there in a month, and that's obviously 24 times 31. If you look at the January contract, so 744 megawatt hours. You have to time that by the price per hour, and that gives you an exposure here, 14,000. 14,000 euros is basically the equivalent of a standard futures contract, but you can, in this case, you can trade it all the way down to one kilowatt. So you can be traded in a tenth of the contract size of the normal futures market. Obviously, as you go out, if you trade it quarterly, the contract value triples, and if you go out to yearly, the contract value gets get even steeper. So that's how it's operating. And just take a look at current prices. If you look at the January contract in European natural gas, or Dutch gas, which obviously is a central hub between the UK market and German market, if we want to move from European megawatt per hour to American standard, then that's the ratio you need to time with plus the currency rate. So that basically means that the current price in Europe is equivalent of $6.80 in US natural gas terms. That's obviously a big difference, but you also know that if you are transporting gas overseas through LNG, there's quite a big cost involved in the gas and the regasification process and the transport, and that basically means that that even at this price difference, the European gas or US gas is still not competitive in Europe relatively to Russian gas, which is predominantly still the where gas is coming from Europe. But for those who are interested, then these are available as CFDs. Let me just see, MP. Spread of US into your cut profile. This that doesn't make completely sense, MP. But please just write me a direct message on tradingfloor.com, and we can take it from there. I'm always open to suggestions for how the cut report is constructed. I just recently changed and added a few things, but anything that you find useful, I'm happy to take a look at. So by all means, please any feedback there is very useful. Finally, how do you find updates? Well, we have a live morning webinar. Which kicks off at 8:40 CET. You just basically have to type in morningcall.saxo, and you go straight into the webinar. And it features John Hardy on macro and FX, Peter Garnery on equities, me on commodities, and on a couple of times a week also a bond update. That webinar will be replayed on Trading Floor later in the day, called From the Floor, and then every day at around lunchtime there's also an update on the Trading Floor called Mid-Session Europe, where I just write a few lines on the different asset classes, what has moved the market today and what's going on. Okay, that's basically it from me. If you let me see what MP writes here, you are very active, MP. Thanks for that. Indeed, following dollar-yen, you very much have to follow the yield curve developments. Obviously, right now the yield curve spread gap between US and Japan is primarily driven by the US, because the Bank of Japan is trying to keep the 10-year JGB yield fairly close to I think it's 0.1%. So that means the big moves there are in dollar yen, or the spread is occurring when there's big moves in US bonds. So obviously that does have quite a significant impact on the movements there, and also in yen. Lars, you were asking about aluminium. I think I saw your question just earlier. Let me just pick it up here. Well, as you rightfully say, I don't follow aluminium that closely. It's not one of the contracts we currently have available on the platform, unfortunately. But it is it is based on fundamentals. One of the metals which has or the industrial metals which have the strongest fundamental outlook for when you look at supply and demand. I just recently I just saw I think it was JP Morgan's latest update. They have two trade ideas. One of them is being long aluminium. That's the one they favor. And again, it's supply and demand driven, and I think that's especially the supply side, because it's also one of the things you need to be focusing on if there are some uncertainties related to Chinese growth into the new year. That's probably as close as I can get at this stage, Lars. Okay, I hope I answered everything I should say about gold. So I think on that note, if there's anyone else, if there's not anything else, then I will finish it off here. Just in recap, the growth story is still attracting a lot of focus in the market. The oil, especially industrial metals, but we have seen the market start to get a little bit worried about the China growth over the coming months, especially here during the winter months where demand tends to slow down. We're a bit worried about the credit impulse, which could indicate that the growth will be potentially slower than the market is currently expecting. Oil markets are rebalancing, but we are nowhere near the goalpost yet, and that means OPEC has to stay the course. They have to maintain that discipline, and with that, there is a just in the short term a potential risk that we have seen the market overextend itself to the upside. The floor in the oil market has no doubt moved quite significantly higher, potentially up towards the 55 area in Brent, and I think there is a risk that we could see that floor being looked after or looked for over in the relatively near future. But first up, we have the OPEC meeting next week, which is going to be very important. Gold has an underlying demand from market participants worried about the very low volatility we have across many asset classes. The geopolitical risk, which has increasingly been resurfacing during 2017, that is helping offset the otherwise headwind that potentially could come from continued rising interest rates in the U.S. and the growth that is still prevalent across the global markets. But we maintain an underlying supportive stance on the sector for the risky reasons, and basically grain markets. It is almost as bad as it can get in our belief. There's not really any. It needs a spark, but at the same time, we know the market is really priced towards lower prices, and if we don't see any additional negative news hit the market, there is a risk of a recovery there, just purely based on positioning. Okay, that's it. I've spoken long enough. I hope you enjoyed it, and you stayed with me all through the 45 minutes. As I said, there will be a replay available on Trading Floor a bit later today. That's it. Thank you very much.